In today's video, we're talking about one of the biggest financial moves of the decade. A move that could reshape global power, international trade, and the future of the US dollar. This story begins with a quiet but massive shift. China reducing and repositioning nearly $3 trillion worth of US-linked assets. While it didn't happen with headlines or breaking news alerts, the impact is now being felt across global markets. So let's break down what really happened, why China made this decision, and what it means for the world. Section 1. The silent move. According to the narrative presented around mid-November, China began pulling back from US assets on a scale that shocked analysts who follow global reserves. There was no press conference, no official announcement, no warnings. Instead, China made a silent financial exit, quietly reducing its exposure to US Treasury bonds, government debt, and other dollar-based holdings. This wasn't a small adjustment. It wasn't routine portfolio management. It was a massive shift involving trillions of dollars, and it sent a clear message. China wants to reduce its dependence on the US dollar. Section 2. Why the dollar matters. To understand the importance of this move, we first need to understand why the US dollar is such a big deal. For almost 8 decades, the US dollar has been the world's most dominant currency. Countries store their reserves in dollars. Most global trade happens in dollars. Oil, commodities, and international settlements all rely heavily on the dollar system. And at the center of this system are US Treasury bonds, considered one of the safest investments in the world. Nations buy these bonds to store their wealth securely, and China has long been one of the largest foreign holders. So if a major economy like China steps away from US bonds, it represents a strategic financial shift with global consequences. Section 3. China's strategy. China's reduction of US assets wasn't random. It was part of a long-term strategy. For years, China has been moving toward economic independence, especially when it comes to currency. The more China grows, the more it wants freedom from systems controlled by the United States. Here are the main reasons behind China's shift. Reducing risk. China doesn't want its financial stability tied to US political decisions. Diversifying reserves. Instead of holding mostly US dollars, China is increasing gold, other currencies, and strategic assets. Strengthening the yuan. China wants the yuan to play a bigger role in international trade, avoiding sanctions pressure. After watching sanctions placed on other countries, China wants to ensure it cannot be financially cornered. This is why the recent move is seen as part of a bigger strategy, not a one-time reaction. Section 4. The $3 trillion impact. Now let's talk about the impact of this shift. When a country offloads or reduces exposure to such a massive volume of US assets, it creates pressure on the dollar volatility in treasury markets. Concerns among US economists, questions about long-term global monetary leadership. The US economy runs heavily on debt. The more countries buy US debt, the easier it is for America to borrow money. If large holders like China step back, borrowing becomes harder and interest rates fluctuate. This is why China's decision is seen as a direct challenge to the dollar's supremacy. Section 5. Dedollarisation. A global trend. China is not alone. Across the world, the process of de-dollarization is accelerating. Countries in Asia, Africa, the Middle East, and South America are experimenting with trade in local currencies. BRICS nations, Brazil, Russia, India, China, and South Africa are exploring alternatives to the dollar. Russia and China already trade large amounts of oil and gas using yuan instead of dollars. This trend doesn't mean the dollar will disappear tomorrow, but it does mean the world is entering a multi-currency era where the dollar no longer stands unchallenged. And China's recent move is one of the biggest pushes in that direction. Section 6. Global reactions. China's quiet exit created waves. Investors became cautious. Analysts questioned the dollar's long-term stability. Financial markets reacted with uncertainty. Central banks around the world started increasing gold reserves, even though the dollar is still strong. The fact that major economies are reducing dependence on it signals a shift in global confidence. Countries are asking themselves, is it safe to rely on the US dollar forever? What if future political tensions lead to economic pressure? Should we diversify before it's too late? China's move has amplified these questions. Section 7. What this means for the future. So what does all this mean? Here are the key possibilities. A multipolar financial system, instead of one dominant currency. Multiple strong currencies may share global trade. Stronger role for the yuan. China's currency could become a popular choice in Asia. And among BRICS nations, more gold reserves. Worldwide countries may use gold as a protection against currency instability. A gradual decline in dollar dominance, not a crash, but a slow reduction in influence. New trade alliances. Nations uncomfortable with U.S. influence may turn toward China. This doesn't mean the dollar is collapsing. It means the world is changing, and China is leading that change. Section 8. Final thoughts. China's $3 trillion reduction in U.S.-linked assets is one of the most significant economic moves of the 21st century. Not because it destroys the U.S. dollar, not because it ends America's financial power overnight, but because it signals a new phase in global economics, a phase where countries want more independence, more control, and more balance in the financial system. The era of a single global currency dominating everything may be coming to an end, and the shift toward a diversified, multi-currency world is accelerating faster than ever before. China's latest move is not the final step, but it is one of the biggest steps yet.